Welcome to the Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. Today is Friday, April 5th, 2024. S&P 500 currently sitting at another almost new all-time high, but not quite, 52.15. I'm David Zarling. I'm here with our resident baseball weather expert, Kevin Ferrari. We had a little bit of excitement yesterday in this market.
Yeah, a little bit of an oopsie, I guess, right? A little sell-off yesterday afternoon.
And it does appear that many investors, now, this Friday is not over, but we have not seen follow-through from yesterday. And the reality being that yesterday's move, we have not seen too many of those, right? Yesterday, the S&P down 1.23%, which in many market environments is pretty normal, but for whatever reason, people get excited in this market environment because we've had such a run since early November that a minus 1.23% move in something like the S&P 500 gets people pretty excited. But it doesn't have to be the beginning of a corrective move. It could be, like if we see follow through in what's called bearish engulfing, what we saw yesterday, we could be on the verge of seeing a correction. But there's a big difference between a correction and a crash. Thoughts on that?
Well, I mean, I think you shared what Charlie Vallejo shared. Was this from, must be yesterday? You know, it's only, the fourth daily decline of 1% or more this year? Which, I mean, I don't think you can be much more spoiled than that so far, huh?
Yeah, for sure.
And then since 1928, there's been an average of 29 of those declines throughout the year. So.
And where are we at now? Where are we at for this year?
Four.
So a negative 1% move or greater, we typically see 29 of those in a year.
Yeah, so like 7.25, roughly, somewhere in there.
Okay.
I don't really know what the distribution of that would be, but.
So 29 of those on average, we're at 4. Now, there's two ways to think about that. So let's use the analogy of weather, if I may.
Mm-hmm.
In Wisconsin, if you went 3 weeks in the spring without a storm, you would say, oh, we're due for a storm.
Yeah.
However, in markets, it doesn't necessarily work that way in the fact that you're always in the same location. You could be in Southern California, and 3 weeks without a storm is perfectly normal. Or 3 weeks with sunshine, you could be some location where 3 weeks of sunshine that's the norm. And so that's the question to be asked is, do you say because there hasn't been a storm that a storm is due? Or are you saying there's a trend here, we might be in a new environment?
Yeah, new climate, if you will.
Yes, new climate. I like that. And really, since we cleared 4180 last year, we've been in a new climate. We've been in higher highs and higher lows. We have rising 200-day moving averages everywhere. We've cleared prior highs in many instruments, such as the S&P 500 or the NASDAQ or mid-caps. We've cleared the late 2021 highs and early 2022 highs. It's only just begun. I mean, it wasn't that long ago, the beginning of January, mid-January, that something like the S&P 500 had a 2-year 0% return. So 2 years with 0% return, and typically on average is around 8 or 9%.
Mm-hmm.
I think it's important to keep in mind that information is that once you make a new high, new highs tend to cluster, and we have this new uptrend on our hands. We have a rising 50-day, rising 200-day. This is happening in U.S. markets and the strongest stocks in the world. Sometimes we just have to shut up and enjoy it. Like, why complain about no storms when we're sitting on the beach?
Yeah, I don't know what the deal is, right? I mean, I think there's so many good signs out there. I think you're just looking for a reason to be skeptical. I don't know.
It's an interesting psychology because I think sports fans do this. I know that I'm guilty of this, that, if your team's off to a hot start in a game, you sit there and go, well, this can't possibly continue.
Mm-hmm.
Or you have your mind set on that so that you preserve your mental capital, your psychological capital, so that if your team loses in the end after being up big, see, I told you so.
Yeah, you feel a little bit better that you knew it was coming.
I know in Wisconsin, it's a fact that there's a lot of Wisconsinites who cheer for the Packers that will legitimately cheer for the Packers, but take a bet against the Packers so that they have a win-win with mental capital, right? If my team wins, great. I paid a premium to get that win. If my team loses, I've got cash.
That's mental hedging.
Mental hedging, yes. This is definitely something that happens, and this appears to be one of those market environments where one foot is out the door by investors. A couple episodes ago, we talked about, we haven't really seen anybody talk about buy the freaking dip. That hasn't become the mantra yet. That was the mantra several years ago when the market wasn't an uptrend. But since the correction of 22 into 23, that's gone away. It's wiped out that sentiment. And so I would argue that we're still in a market environment that signals skepticism, maybe on the verge of optimism. I mean, there's definitely optimists out there. I don't want to make it sound like everybody's being negative, but the sentiment still seems to be one foot out the door.
Well, yeah, because what was just a couple days ago, Ian, I think, shared that tweet. I'm trying to remember who that was from, but talking about if equities are on borrowed time.
Oh, sure. Yeah. There's several interesting social media personalities who have had relationships with mutual funds or ETFs in the past or currently that are using terms like crash. I always get nervous about individuals like that because they can be wrong for 6 to 12 months and then pound their chest when the market does crash.
So you say it long enough, you're bound to be right eventually, right?
Yes. Yeah, exactly. Let's be honest about the data. I mean, the amount of 7 to 10% corrections that you typically see in a calendar year for the market is pretty high.
Mm-hmm.
So we could pull back in something like the S&P 500 to a 50-day moving average. That would be perfectly normal. That would be 4% off the highs. You could pull all the way back into the prior highs at 4,800, and that would be an 8 or 9% correction. Would it be comfortable? No, people wouldn't like that. But after clearing these new highs, to have something like that take place would be perfect. I mean, it would match seasonality, would it not?
Well, right. I was say we were kind of talking about that before we started recording, right? So, like, kind of like your election year seasonality, kind of moving into, this week kind of more spring, early summer. Like, you kind of expect more of a, I guess, kind of sideways market, I guess.
Right.
So in that, I think that was kind of initially looking at that where my head first went to was, with us essentially kind of following the opposite side of the coin of what you'd expect for early year seasonality during this time period. I mean, right, it's supposed to be, more of a period of negative performance where, obviously that didn't happen.
You're talking about March.
Right. Yep. Kind of into March.
Yeah, that March was seasonally typically has a tendency to be negative and wasn't. That's where you get to say, am I not in Wisconsin? Am I in Southern California?
Right. So, yeah, because, I think, right, there's kind of two ways you can look at it. And I guess initially my first thought was, are we actually going to have more of a, move here, through April, or it's a little bit more reversion to the mean maybe with kind of like a pullback in the previous highs like you talked about?
Mm-hmm.
Or kind of your point, we're just in an uptrend and we're going to ride it out. There's really no way to know.
Yeah, you typically don't know until afterwards. You have your price levels pre-established. We've talked about 4,800 on here. That's 8% away. The first thing you would see is losing something like a 50-day moving average. But even that wouldn't be the end of the world, right? You could have a consolidation, which would be wonderful. We could consolidate summertime, no matter the market cycle, whether we're just talking a 4-year cycle, 10-year cycle, 5-year cycle, presidential cycle. Your summertime tends to be weak. April's a transitional month, right? That's the end of the strongest 6 months. November, December, January, February, March, April are the strongest 6 months of any 12-month period from a seasonal perspective. We've just had a great November, December, January, February, March. Does April continue, or do we transition into this flat, grindy, sideways effort in summer? Even if we did, that would be
perfectly healthy,
perfectly normal. If we build some type of 7% range, really investors would have to be, this is not a recommendation, but investors would have to be looking to get involved at that point. if they haven't been, because this market has not let anybody in. All it's done is moved higher. Not every single day, obviously, but the trend has been higher. It's been pretty direct since the flush, the table that was set in late October, early November with the breadth expansion. Here we have a situation where your large cap tech stocks have corrected this first part of the year. I'll use Apple as an example. Not every single large cap tech, but Apple, is basically almost flat since October of last year, but it's sitting at a really important horizontal level. So one of the more important stocks in the market is an important horizontal level. You mentioned before this recording, Amazon, right? It's right on the verge of new all-time highs. There's some really quality pieces that are setting up that you could also see a scenario where we don't pause in the summer.
Yeah. And I think, you talked about kind of like broad tech, right? Not necessarily correcting, on an absolute basis, but really, I guess broadly they have been on a relative basis, right? So is that really, more so just what it's going to be, more of a, relative participation pause. And then, like you said, we kind of get into late spring, early summer, and we just keep going.
Well, so you're using something like XLK, which represents the tech sector overall, comparing it to the S&P and saying this is a pretty normal pullback in that relationship, and it's sitting there waiting for that rotation back into it. Is that that relationship, XLK divided by S&P, which is really important relationship, right? You want to see tech lead, has been correcting since the end of January. That doesn't mean all stocks have been correcting. It just means that relationship has been. But here has pulled back since
right,
then.
200-day.
Yeah, right into a 200-day moving average. Do you see a resurgence of tech over the summertime? If that's followed with participation in small caps, meaning small caps staying above 210 in something like IWM and moving higher, like how broad does this market get? And there's some signals there, right? When we look at areas of the market that don't really carry a lot of cap weighting, like energy.
Energy looks good.
Yeah, energy looks really good, which is a really great segue for us to talk about a whole entire asset class that we haven't necessarily talked about in a while, and that's commodities.
Yeah, really for most part of the year, really hasn't been too much going on there. But, when you look at kind of some of your more broad commodity funds like GCC, kind of breaking out of a base here on a weekly, goes back to, kind of the end of 2022. Really nice weekly candle today.
Yeah, it's the GCC is a continuous commodity index. It's a little more broad-based, right, Kevin? It's not, so energy-centric. Obviously, it has energy commodities in it. But it's not some of your other commodity funds, which are so oil-centric, that kind of overlaps everything. This is a little more broad-based. Am I right in that?
Yeah, so energy as a whole is 30% weighted within there, and of that, it's only got about, around 20% oil. And then you get, mostly gasoline in there. Around 18% greens, 6.5% sauce. They got livestock, separated from there around 4%. Kind of the other area we were kind of talking about too is, your metals, with like 15% precious metals and around 22% industrial metals. So it's pretty well distributed.
Yeah, no, you said that well. It's well distributed. It's a good representation of commodities overall. Here you have it breaking out on an absolute basis, so just looking at it on its own. There's an argument to be made on the move that it's made since, let's call it, end of February, a relationship versus S&P 500. Now, it's a declining 200-day in that relationship, but it's rebounding at a level that makes perfect logical sense. And you're seeing other characteristics that match, right? If I can use the weather analogy again, if you see clouds and you see lightning and you hear thunder, the ingredients are here for a storm. In commodities, you're seeing the same thing. You're seeing oil breakout. You're seeing gold and gold miners breaking out. You're seeing copper move higher.
Silver.
Yeah, silver move higher. And in some ways, if you were to draw up the perfect scenario on an environment where precious metals are doing well, it's the miners are doing better than the metal. And this would be the first week of that ignition if it took place.
That relationship too, like I guess the first one I just pulled up is like gold miners to gold. So like GDX, GLD. At kind of a natural spot, you would expect that, relationship to kind of hold and start moving in the other direction. So
yeah, something like COPX, which is copper miners with I believe, and you can check this as I'm opening my mouth, is you have something like Freeport McMoran is probably the largest holding in that. That is on the verge of new, fresh all-time highs. It's not there yet. Beginning of 2022 would have been highs there. But if we clear this after what some technicians would call a Wyckoff type of wraparound prior highs and move higher, you could see copper miners do really well. And copper, they call it Dr. Copper for a reason, is that, now I'm using copper miners, but it's an economically sensitive metal that if we continue to see that climb higher, that would signify some really quality environmental information for asset classes overall. I mean, there are environments where commodities and stocks rise together.
Yeah, and actually even steel too lately has been looking pretty good. Like individual companies within there, STLD, Steel Dynamics, has been on quite the run. So, yeah, I think, within that industrial metal space, it's been pretty broad participation, it seems like, within that area for the most part.
Industrial metals, base metals, like if you look at something like DBB, also moving higher this week. And I think there's a couple pieces that we have to tie together here. Like this may be the most we've talked about commodities overall on the podcast in quite a bit. I know they get touched base on, but probably not since the beginning of 2022 have we talked about this. Now, beginning of 2022 was an interesting environment because you had equities correcting and commodities doing well. This is a different environment, I would argue, because you're seeing equities do well and now commodities are joining the party, which tends to be, I believe, at stage 3 or stage 4 of the business cycle where you're seeing economic expansion. And that just doesn't seem to be the mantra in the financial media, is that things are really good economically.
And within that stage, right? I mean, there's plenty of room to run yet too.
Oh, so absolutely.
Like we're just getting started, really, if that is the case.
And it also checks the box for what would you see in an inflationary environment. You would see commodities do well. You would see stocks do well. And when you look at a relationship like inflation protected security, like TIPS versus a 7 to 10 year treasury, we've been doing nothing but move higher since the beginning of the year. And you could see a resurgence we haven't even talked about agriculture commodities. I don't know what you do if you're mixing cocoa with coffee, how you can even afford that.
No, I don't know what the deal is with cocoa. If they found out, you can run your cars on that or something. I don't know, but that, year to date, cocoa's up 160%.
Man.
And just softs in general are kind of your top performing. I kind of consider those more, I guess, on the agricultural side of it.
Yeah, can you walk people through, they're not familiar with that term, what the different types of commodities and what softs are?
Yeah, so your softs are, which I guess I don't know necessarily how they make this designation, but it's like your non-traditional, I guess, agricultural commodities, so like cocoa, I think orange juice gets thrown in there, coffee,
Cotton,
sugar, cotton,
lumber.
Yeah.
Because lumber's not soft. I mean, we use it in baseball.
Right, that is true.
I've never hit somebody with a bat, but...
No, I've been swinging some 2x4s around a little bit lately. Yeah, they seem hard enough.
Yeah, not so much here, but right here
right
is where it hurts. It's an interesting area. Cocoa's been ripping, coffee's been ripping, and what I mean by that is moving higher aggressively. You compare that side by side with grains, we're kind of seeing the opposite.
Right. Yep. Actually negative year to date, like corn down 10.5%, oats kind of similar, wheat down 10%, soybeans almost 9%.
You can never take commodities. It's nice to look at them as a basket, absolutely. But it's also nice to know what's happening inside, what's happening in the internals. And it is interesting to note that your softs, your energy commodities, and your industrial metals and your precious metals are all moving higher. There's definitely some inflationary characteristics to this. You throw in gold miners and copper miners and silver miners. You even throw in something like, inflation-protected securities versus your regular bonds. inflation appears to be rearing its head again, which many consumers would be like, are you kidding me? Like, why would you bring us this type of information? And I don't want to downplay what families are seeing at the supermarket. That is real, right? I see bills too.
Mm-hmm.
And there's real ramifications for the consumer. But this also reminds us why we're involved with markets to begin with. You know, whether the mantras of the day of whether we're buying meme coins, or I'm not saying we are, I'm just saying like things that are top of sentiment currently, you know, meme coins and crypto, zero date expiration options. Those can be all fun and borderline on the verge of gambling. But the real reason why we're involved with markets is not because they're fun, not because we get an emotional charge. It's because we need to protect our purchasing power.
Mm-hmm.
And that's the end result. That's why we do financial planning for our clients. That's why we're involved in markets. That's why we use technical analysis to identify price, trend, and relative strength. We're starting to see a resurgence in things that are inflationary, and it's why clients are familiar with those things being involved in their portfolios, is because really we're in the business of protecting the purchasing power of the dollar. Right? Because when you're retired, you no longer have your normal income. That's what you're going to be living off of. So you have to keep pace. That's why our clients do see some commodity exposure, because on a relative basis, these things are doing well. All of these things are related to currencies. What are we seeing from a currency perspective out there that you think is worth noting, Kevin?
Sure. Well, actually, I'm going to take one step back, just to your point there about, you know, inflation. I think now with an environment, right, where you have rising rates, higher interest rates, I think it's actually easier to lose sight of that being really the end goal, you know, managing accounts, right? Because you're seeing 5.5%, you know, T-bills. You start having those conversations with clients more about, well, why shouldn't I just lock in this, you know, CD rate at 5-6%, or you got T-bills here, and, you know, why don't you start buying some bonds? I mean, that's, you know, really probably the exact wrong time to be doing things like that, right? When you're seeing kind of this inflationary pressure, you know, you could be in a situation where you're really just locking in your inability to protect your purchasing power, right? Which it's just an interesting dynamic.
No, that's a great point. You're just saying like, hey, when you see this super sentiment into let's buy T-bills and get that guaranteed 5% or that CD, meanwhile, you see all these things that are moving, you know, whether it's equities plus 10% or whether you're talking about some of these agriculture items that have a direct impact on your grocery cart that are moving 300%, that's a real world relationship.
Mm-hmm.
And that's why you involve a planner. That's why you involve an advisor, is their job is to protect you from that type of mentality. I understand, Mr. and Mrs. Client, why 5% is appealing, guaranteed, because we haven't seen that for years. We haven't seen that for years. But that's also tends to be when we see other things outpace that 5%. And that's exactly what we've seen for the past. If you missed it, in some sense, it's almost like missing 3 to 5 years of T-bill coupon payment. And you've accomplished that in 4 years or 4 months. So great point on that.
Which, man, it's crazy to think about when you put it in terms of time like that, right? I think that really kind of hits home. Because, you know, you got like these performance returns, things like that. There's kind of numbers, but you put that in terms of time. Like everybody knows, you know, how important time is. And it's a different way to think about it for sure.
Time is a currency.
Mm-hmm. Probably the most important currency, right?
It is the most important currency.
I mean, you can't necessarily go to the grocery store and buy, you know, some bread and time, but
the only way I know how to buy time, Kevin, is there's this thing called eternity in heaven, and I'm the king of sinners, and Jesus died for that, and because of that, I get eternal time. That's the only way I know. As far as earthly time goes, I have no idea. I could be gone. This could be my last episode, Kevin.
Could be.
I have no idea. But your point is exactly right. Like, you can't just go to the store and buy more time.
Mm-hmm.
And that's an opportunity cost. And so as you are near retirement or in retirement, these things become more apparent, right? Many 30 and 40-year-olds aren't necessarily thinking about that. But it becomes more apparent when you're in your 50s and 60s. Oh, I have some semblance of time. We don't have any 150-year-olds around us, that our time is finite. And so now, how are we going to live gifts that have been given us? What are the finances that have been giving us? You can't just sit in T-bills if you're sitting in T-bills at 5% and here you have inflation at 8%, I'm making up a number, you're now in the negative. And that's why you have to be involved. I mean, it's really eye-opening to see what's going on with some of these commodities. It really is. And it's worth paying attention to. And it goes back to, you do have environments where commodities and stocks move together. And we know that we really enjoy environments where there's differentiation, that it's not just the S&P, that you have things like commodities that outpace them. That's a fun environment. We should enjoy that.
Yeah, the more you can participate in, the better really for us, right? It makes it a little bit more fun.
Absolutely. Totally agree with that. So we've talked US equities, we've talked commodities, touched base a little bit on energy. Currency-wise, we continue to see a flat 200-day on a trade-weighted basis for the dollar.
DXY, what we usually use for that?
Yeah, yes, correct. DXY. When you look at the majors, right, your 8 majors, the dollar, euro, yen, British pound, Canadian dollar, Swiss franc, Australian dollar, New Zealand dollar. What's interesting is really it's the US dollar that's lower left, upper right. The rest are upper left to lower right. And we'll see what that brings in the coming months and days, but it continues to be US stocks over international stocks. Doesn't always have to stay that way, but that's where we're at right now. And one of the major pairs, the yen versus the US dollar, is at a really important horizontal level. And then, we talked about seasonality. If we look at international stocks versus S&P, still in a downtrend. But if we get into the minutia a little bit more, if we look at style box, meaning like mid caps, small caps, or even if we're looking at like sub industries, anything there, Kevin, that you're looking at that's kind of caught your eye or worth noting?
I feel like, obviously we talked about small caps quite a bit. How that's kind of the ace up the sleeve yet, as far as, like if we see them finally start to participate, what that might mean for the market as a whole. So, really mid caps, still hanging in there, on an absolute basis, and even still, on a relative basis to the S&P, which is nice to see.
Yeah, absolutely. Well, in this small caps relationship on a relative basis to S&P, we're still at this horizontal level that is holding when we go back and look at the massive breadth expansion that took place in late October 23, early November. It doesn't have to hold. If it holds, it's tremendous information and a tremendous opportunity from opportunity cost and differentiation from the broad index of something like the S&P 500. So we'll see. We'll see if small caps can catch up. Mid caps have cleared their prior highs, also showing some potential from a relative strength standpoint. When you look at something like high beta versus low volatility, that is still trying to work through an area that has been resistance in the past, going back to 2021. If we clear that, that would be extremely bullish information. And so we'll see. We'll see what the market gives us in the days and weeks to come. We've kind of talked bullish on this episode, Kevin. Where would we be wrong? What are some price levels or relationships or things that we would be looking at to say, hey, the thesis of a strong summer or even a sideways summer. So we'd be looking at a corrective summer. What information would we be looking at to be like, we might have a correction upon our hands, which would, by the way, would be perfectly normal. But what were some things we'd be looking at that would kind of highlight the potential increasing for that?
Well, I know you kind of mentioned Apple already, right? I think Apple below like roughly 168, something like that, maybe 167 would definitely be kind of a red flag, which then kind of makes you wonder, is tech going to kind of continue to cool off and maybe get into an area where maybe you see that more on a broad level?
Yeah.
It's okay.
You're just saying like Apple could potentially be a canary in the coal mine below 168. And if we see tech follow suit, the rest of the team follow the quarterback down, that would be indicative of a corrective market. Is that a fair way to represent that?
Yeah, exactly.
Anything else? What else would you be looking at?
Question.
For me, I think junk bonds, unadjusted basis, so taking out the yield, this horizontal level that we see in something like J&K around 93, if we're not holding that and we're seeing credit spreads widen, like moving higher, that would be indicative of low liquidity and less risk-taking. and that's where I would be if we break 93 on something like JNK on a basis where we're taking the yield out. That would raise some eyebrows for me.
Mm-hmm.
And if we lose in small caps prior highs near 197, again, that could be consolidative. I mean, and that would be perfectly healthy. But if you were seeing small caps breaking down on a relative basis versus S&P, like breaking the low that we saw established at the very infancy of the breadth expansion, that would have my attention. So really it's a credit market / risk horizon type scenario where if you see things like small caps and micro caps fall off, if you no longer see semiconductors holding up, if you see credit spreads widening, that would be something worth paying attention to. And I admittedly, gold has piqued my interest. Like, we haven't seen this type of strength in gold in a while. There's times where gold just trends and it does its thing, and there's times where gold gets it a bid because it is a risk-off environment.
Mm-hmm.
So if you saw,
dramatic, I mean, that's been pretty dramatic, over the last couple of weeks, like GLD.
Yeah, for sure. And so if you see that, I would be a little bit more concerned if I saw industrial metals selling and precious metals ripping and miners not following. That would be, it would just be someone on the side of the road waving a flag that I'd be like, wait, what? What's going on here? But you have this combination effect of miners are also moving higher. Your industrial economic sensitive metals are moving higher. Are they in an uptrend yet? No. Gold is. And so gold just may be entering a new trend that's perfectly normal because it hasn't moved anywhere for years.
It seems like ever. Yeah.
The range that we've been in since August of 2020, but in reality, we're just now clearing the September 2011 highs. That's 13 years ago, and we're now clearing that. Okay, that's information. Like, gold could just be doing gold things and not be a signal of risk-off behavior. And so it is a unique time in history, and I love that you and I get to be a part of it together, Kevin, because there was a time in a previous era, and I would describe that as a falling rate, rising bond era, where if gold was up, the yen was up, and treasuries were up, that was risk-off.
Mm-hmm.
I don't know that we get to use those signals anymore. We might have to be a little bit more judicious and detail-oriented in our analysis to understand when it is risk-off.
Mm-hmm. Because
you could see gold move higher and treasuries and the yen move lower in a risk-off environment. That could happen. Treasuries have been this is the longest correction we've seen in a long time in treasuries. Treasuries are still in a downtrend.
Mm-hmm.
They still don't belong in a portfolio, even though my guess is most of the people that aren't clients here that walk through our doors have exposure to treasuries and bonds overall in a 60-40 portfolio, and that is not appropriate.
Yeah, especially long-term bonds.
Yes.
That's what your makeup is, like your short-term, either treasuries or commercial paper, things like that might be a place for it. But
yeah, I need to be better at when I describe that I don't lump in the short duration, because you're exactly right. Your T-bills, your corporate paper, even some of your high yield areas, these are places that you can get yield with less risk than you would if you took on a treasury, which that's information too, by the way. But
which actually, when you think about, I think one area we're looking at this week, like emerging markets high yield, is actually looking pretty good, which is interesting.
Yeah, is that risk off, Kevin? If emerging markets, so you think about high yield being more risk than your more conservative credit, but now we're talking emerging markets.
Emerging markets. Yeah. I mean, I'm not a fixed income specialist by any means, but I would, if you ask me that question, I would definitely think that's not risk-off behavior.
Yeah. Like, hey, Mom, I'm going out and I'm buying high yield. No, wait, I'm going out and I'm buying emerging market high yield. Mom's curfew might tighten up. That is definitely risk-taking. And so when you see that type of demand for emerging market high yield credit, that's a great point, Kevin. I almost want to leave it right there, because that may be the other type of flag, right? Not the red flag, but the green flag that people need to be paying attention to is that how risk off is it in this environment if there's enough demand to see a new uptrend developing for emerging market high yield.
Can't argue with that.
So I think that's a great place for us to say we reached the end of our podcast. I always like highlighting the supporter of our podcast, Adaptive Select ETF, which is listed on the NYSE under ticker ADPV, which helps investors access two of the most prevalent factors in markets, momentum and relative strength. Using proprietary identification methods, the Adaptive Select ETF attempts to own the strongest 25 large cap stocks when the market is in an uptrend. And since not all market environments are the same, Adaptive Select seeks to prevent extended declines by moving to short-term treasury bills and cash during long-term market downtrends. Investors can find out more, including how to invest in ADPV, by visiting adpvetf.com or calling 1-833-880-5200. Investing involves risk, including possible loss of principal. ADPV is distributed by Quasar Distributors, LLC. With that commercial out of the way, Kevin, really loved having you on the podcast. Anything else you want to touch base on before we close it out?
No, I don't think so. I mean, right, I guess you're seeing, kind of like you're saying, more green flags necessarily at this point than red flags, right? We just talked about emerging market high yield. Frontier markets are starting to look more interesting on an absolute basis, which is hard to say that's risk-off behavior. Staples have kind of turned back around and they continue breaking down on a relative basis. Still not necessarily anything to see from utilities. So, yeah, I mean, I think it's definitely more of an optimistic picture, at least for me, than pessimistic at this point.
Yeah, I think that's a great point. You don't necessarily ever check all the boxes. And in fact, I would argue when you check all the boxes, that typically tends to be when you're near a market top.
Oh, yeah, then you really got to start questioning things.
Yeah, you got to really start questioning things. But your point is more green flags and red flags. Mm-hmm. And I think that's a great way to put it. In fact, we might make that the title of the podcast. It's never a perfect picture, but all the flags are aligned. The signals are aligned for whether it's a sideways summer or even a surprisingly bullish summer. This is what it would look like. So great job, Kevin. Love having you on here. Thanks for filling for Ian, who has a well-deserved day off. Thanks for doing this with me.
Yeah, for sure. Absolutely.
Take care, everyone. If you guys love this podcast, you love the information, we love it when you share it. We love it when you give us high rankings. That gives us affirmation. We really appreciate it. Have a great weekend, everybody.
Yep, have a good weekend.